Hi, welcome back. This is Judith Paquette, and we move on to part 2. So far, this has all been review. Now we move on to the meat of accounts receivable. Understanding how to account for accounts receivable, how to value it. That means how much of what we say is in accounts receivable can we really collect out of all of it. Also, how to write off the amounts that cannot be collected, and how we book the recovery if later the customer finds that he or she is actually able to pay the bill. This concept of valuing accounts receivable means that companies must report accounts receivable at something called net realizable value, which means at the amount that they believe, they estimate, they will actually collect. Companies estimate many things, and the actual amount of accounts receivable that it will collect is one of them. Estimations are not black and white. They require judgment and a rational basis for the estimation. Companies have to provide history, data. They have to consider current economic conditions to come up with the estimation. Finally, after the estimate is made, a journal entry is made to reflect the estimate. And then, if a customer cannot or will not pay a bill, the account must be written off, removed from accounts receivable. When it comes to writing off accounts receivable, the only method allowed using GAAP, remember what GAAP is, Generally Accepted Accounting Principles. The only method allowed is the allowance method, and under that there are two methods, percent of accounts receivable or percent of sales. The direct write-off method is not allowed under GAAP. Now, if you are a really tiny company, you are allowed to do the direct write-off method. But for major corporations, it is just not allowed. In the allowance method, losses are estimated early when the sale is booked, or at least at the end of the month or period. And by losses, I mean bad debts. This is an estimate. We don't know for sure, period. This results in better matching of costs with sales, and that adheres to that value, that principle of accounting, the matching principle. The allowance method introduces us to a brand new account. This is an account title. I know it's long, Allowance for Doubtful Accounts. You can abbreviate it as ADA in your journal entries. Some textbooks call it Allowance for Bad Debts. Some textbooks say Allowance for Uncollectible Accounts. This account is an asset, but it is a contra asset, and that means that it has a normal credit balance. This account serves as a type of reserve that a company can use to write off customer accounts which cannot be paid. So let's take an example. Let's say a company has to estimate what the uncollectible amount is. This is the journal entry to make that estimation. Let's assume that the total amount of accounts receivable is $75,000. And it estimates out of the $75,000, $6,000 of it is uncollectible. This is the journal entry to estimate the bad debt. Bad debt expense, $6,000 debit. Allowance for doubtful accounts, $6,000 credit. Note that we use bad debt expense, which is also a new account for this chapter. And we are not yet saying we want to write off this customer's account or that customer's account. This is just about the estimate. Allowance for doubtful accounts is a permanent account and it is listed with the assets. Please note that when we make this estimate, bad debt expense is debited. All the expenses show up on the income statement, and when expenses go up, net income goes down. So at the point that we make this estimate, profit goes down by $6,000. So it's important that we do a good job in our estimation. How does this look on the balance sheet? A couple of ways I'm going to show you. You can list each account separately. Accounts receivable, allowance for doubtful accounts, $75,000, debit balance, $6,000, credit balance, net realizable value, $69,000. Or you can show it this way. Accounts receivable, net of $6,000, allowance for doubtful accounts, $69,000. So if I showed it to you this way, I could ask you, what is the gross amount of accounts receivable? And you would take the $69,000 plus the allowance to get to the gross amount, $75,000. While on the previous page, we showed that calculation. Here we're just showing the net amount. Now, how does a company write off a bad debt? The customer owes money. That's $750. It is sitting in accounts receivable. Collection calls are made. The customer declares bankruptcy or says they cannot pay, will not pay, and the company must write off the accounts receivable. This is the journal entry to write it off. When we use the language write off, we are saying it was an asset, it was in accounts receivable, now we're taking it out of accounts receivable with a credit. Normally you would credit accounts receivable when the customer pays, but we're saying no, the customer isn't paying, so we're writing it off to allowance for doubtful accounts. This is where the company dips into that reserve. After the write-off, how would it look? Accounts receivable would have been reduced by $750. The allowance for doubtful accounts would also be reduced by $750. But note that the net realizable value does not change. All right. Let's say 8 months later, company comes back and says, we can pay that bill now, and we want to. And they give us a check for $750. Here's how the entry will be booked in 2 journal entries. First, you reinstate the write-off of the bad debt. Put it back on accounts receivable, increase accounts receivable, put the write-off back onto the books. This $750 should be up here. So we've just reversed that transaction, and then we show the collection. Debit cash, credit accounts receivable. This ends part 2 of the videos.